Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Claros Mortgage Trust, and let me tell you, it's not exactly a thriller, more like a financial yawn, but hopefully we can make it a page turner. This report is about a change to a loan agreement. Basically, Claros Mortgage Trust, through one of their subsidiaries, made a deal with Wells Fargo Bank to borrow money, and now they've changed the terms. We'll look at what this change means and why it might be important. By the way, before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. This document is a Form 8K, also known as a current report. Companies file these with the Securities and Exchange Commission, or SEC, to announce major events that could be important to investors. The most recent event that triggered this report happened on June 16, 2025, so this is pretty fresh information. The company we're talking about is Claros Mortgage Trust Inc., which is a real estate investment trust, or REIT. This makes a company that owns or finances real estate. Now, let's get to the heart of the matter. Item 1.01 tells us this report is about a significant agreement that they've entered into or changed. In this case, it's a modification, meaning an update to an existing agreement. The report states that CMTGWF Finance LLC, which is a subsidiary, think of it like a smaller division of Claros Mortgage Trust modified, meaning changed certain terms of its repurchase agreement with Wells Fargo Bank. A repurchase agreement, or repo, is basically a short-term loan. The subsidiary sells some of its assets, usually mortgages in this case, to Wells Fargo with an agreement to buy them back later. It's like putting something in pawn in order to get a cash loan. The biggest change is that the maximum facility amount was reduced to $250 million. The facility amount is basically the total amount of money that the subsidiary can borrow under this agreement. It sounds like they can only borrow $250 million now, which could be good or bad depending on how much they had before Tolechem. So what does this modification really mean? Well, it means Claros Mortgage Trust's subsidiary now has less borrowing power from Wells Fargo. This could be because Wells Fargo is getting concerned about the types of loans Claros is giving out, or it could be Claros is not requesting borrowing that high anymore. If Claros needs more funding in the future for new deals or to cover existing obligations, they might have to find it somewhere else. That could involve getting loans from other sources at potentially higher interest rates, selling off assets, or issuing more stock, which could dilute the value of existing shares. On the other hand, this could also be a positive sign. Maybe Claros Mortgage Trust is doing well and doesn't need to borrow as much money. Perhaps they're being more cautious about taking on debt, which could be a good thing in the long run. Now let's talk about what all these numbers mean. To figure out what's really going on, we need a little context. Claros Mortgage Trust operates as a commercial real estate mortgage REIT, so it focuses on originating, acquiring, and managing commercial real estate loans and related assets. This means their results will be closely tied to the commercial real estate market, and that market has had its share of ups and downs recently. Otherwise, think about how they manage debt and risk. Based on the information provided, Claros Mortgage Trust has reduced their available borrowing capacity, meaning they have less wiggle room if things get tight. This could suggest concerns about the stability of their investments. However, maybe they have turned a new leaf and are proactively reducing debt and increasing cash reserves. This could make them less vulnerable to market downturns. The commercial real estate market can be unpredictable, and it can be impacted by interest rate changes, economic conditions, and changes in demand for office space, retail, and other types of properties. Given these uncertainties, Claros' recent financial moves could be defensive, showing they're preparing for potential difficulties by reducing their exposure. The decision to reduce available borrowing might provide more control over debt levels and reduce interest expenses. However, it could also limit their ability to jump on new attractive investment opportunities. And to now, in conclusion, Claros Mortgage Trust's decision to reduce its borrowing capacity could reflect a strategic shift towards reducing debt in the face of economic uncertainty. However, this decision is a double-edged sword. While decreasing debt can stabilize their financial standing, it simultaneously curtails their ability to seize on new prospects. Ultimately, whether this strategic alteration is truly advantageous will depend on how well Claros is able to navigate the always changing commercial real estate landscape. Alright, that's our breakdown of Claros Mortgage Trust's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.